Yeah, okay, great. Well, thank you very much for having me. Really been looking forward to this. This paper is joint work with Eben Lazarus at MIT, and it's called Duration-Driven Returns. And basically in this paper, what we want to do is to understand the major equity risk factors in asset pricing. So we want to understand risk factors based on value, profit, investment, low risk, and payout ratios. And these are risk factors we all know. They are strong, they predict returns well, even among large cap stocks, and they are persistent. And they're also playing prominent roles in our leading factor models like the Farmer and French model. But despite this prominence, we still don't have a very good understanding of why these risk factors exist. We don't have a very good understanding of the economics behind why all of these risk factors exist at the same time. And one of the challenges is that it's hard to relate these risk factors based on these names, but more generally it's hard to relate these risk factors to economic fundamentals, and it's hard to relate them to one another. But what we're doing in this paper is we're showing that while these risk factors, they look or sound very different when you just look at their names up there, they actually share a very fundamental economic characteristic, and that is that they invest in firms with low growth rates. And because these firms have low growth rates, they also have a short cash flow duration, as I'll explain in a second, and therefore they can be summarized by a duration factor. And then we're going to go on, so that's going to be sort of a fact about what these risk factors share, but then we're going to go on to use some new data and to argue that this short cash flow duration is actually going to be key in understanding their expected returns, in the sense that the reason they have high expected returns is essentially that they invest in short duration firms. I'll also be more clear about what we mean about that later. But first, duration, we know that from the fixed income literature, that's just defined as the value-weighted time to maturity of an asset's future cash flows, right? So you take how many years into the future each cash flows is paid out and multiply it by how large it is relative to the other cash flows, like the present value, the relative present value. So in fixed income literature, you often think of duration as being a measure of interest rate sensitivity, how much prices move when interest rates move. And we're going to keep that in the back of our mind here, that duration is capturing how sensitive assets are to changes in discount rates. But we're mainly going to think of duration as a measure of the timing of cash flows. We're just going to use it basically to say whether an asset earns money in the near future or the more distant future. The other thing is that in the fixed income literature, we often pin down the duration more or less by the maturity of the bond. A bond with a 20-year maturity has a longer duration than a bond with a 5-year maturity. Now for equities are perpetuities, so that's not going to work. Instead, what we're going to what's going to be the driver of duration in the cross-section among stocks is going to be that some firms have high growth rates. If a firm has very high growth rates, it means that the distant future cash flows are going to be large relative to the near future cash flows, so the duration is going to be longer. On the other hand, if the firm has very low growth rates or negative growth rates, the distant future cash flows are going to be low, so most of the cash flows are going to be in the near future and the duration is going to be shorter, roughly speaking. So what we then do is we take the firms and the major risk factors and we look at what they look like in terms of duration. And here what I'm plotting is then the future 15 years cash flow for firms in the long and the short leg of the risk factors, where what we do is we just say this is years after portfolio formation for the firms in the long leg and the short leg, and then we look at how big the cash flows are and calculate what their weight is to their relative present value. And what you can see is that the firms in the long leg of the risk factor generally have a larger weight on the near future cash flows and a relatively small weight on the distant future cash flows, and the opposite is the case for the firms in the short leg of the risk factor. So this is based on an average of all the risk factors, but it also holds for each of the risk factors on their own. Was that a clarifying question? No, sorry, okay. So it holds for all of the risk factors on their own. So that's sort of a new fact these risk factors share, that they tend to invest in firms that earn most of their cash flows in the near future and short firms that earn most of their cash flows in the distant future. And therefore, they can be summarized by this new duration factor. Good, so that's the first fact. Then we're going to go on to argue more aggressively that these risk factors actually arise because they have this tendency to invest in short duration firms. And here the argument is based on the equity terms, the literature in the equity term structure. So as Jules would have known if he was in this room now, but unfortunately can't come and discuss, he's kept out by the snow, but he's sort of been working on the equity term structure and showed what they find in that literature is that near future cash flows have higher risk-adjusted returns than distant future cash flows. Right? So if you look at the market portfolio as a whole, the dividends in the market portfolio that are paid out in the near future have higher risk-adjusted returns than the dividends that are paid out in the very distant future. So given that finding, it's only natural that the firms that produce these cash flows actually also have high risk-adjusted returns, right? And that's basically the argument we're going to push in this paper, that these risk factors arise as a product of this premium and near future cash flows. So to be precise in our hypothesis, recall that we can always write the expected return on an asset as the value-weighted return on all the future cash flows that this asset is going to give you. So for an equity, it's just going to be the value-weighted return to all the future cash flows paid out in the firm. So what we're going to argue is that these cash flows here, they are more or less the same across firms. So like a value firm has higher expected return than a growth firm. But if you look at the 3-year cash flow on a value firm, it has more or less the same risk-adjusted return as the 3-year cash flow on a growth firm. Instead, the reason that the value firm has higher return on average than the growth firm is that they load more on the near future cash flows. And the near future cash flows have high risk-adjusted returns. So basically, the returns on each cash flow look similar across firms, but decreases in maturity for all of them. And then what's really going to drive, so what's driving the differences in expected returns is differences in the weights or the duration of these cash flows, right? If there's a large weight on near future cash flow, you have high risk-adjusted return and vice versa. So this is an hypothesis, and it might seem like something that's hard to test, but actually there is this new data of single stock dividend futures, which are basically claims on individual dividends on individual firms. So I can go out, and I'll talk more about this later, but I can go out and buy the dividend that's paid out on Apple in 2023, for instance. That's one specific cash flow on one specific firm. Then we can use these dividends to study whether the returns on cash flows with a specific maturity is the same across firms, like we are arguing that they are. And basically what we do is we take the firms with the long leg of the risk factors and the firms with the short leg of the risk factors, just like we did before, and then we look at what's the CAPM alpha on the 1-year, 2-year, 3-year, and 4-year dividends to these firms, right? And what you can see is that for both the long leg and the short leg, the CAPM alpha decreases in maturity, consistent with the findings in the equity term structure. There's a higher risk-adjusted return in the short end, and it decreases with maturity. But what's interesting is that these CAPM alphas are more or less the same across firms. There's not a tendency for the firms in the long leg of the risk factors to have higher returns on these cash flows with a fixed maturity. So a value firm with a 3-year maturity has the same, the cash flows on a 3-year, on a value firm with 3-year maturity, the 3-year cash flow on a value firm has the same risk-adjusted return as the 3-year cash flow on a growth firm, basically. So this is consistent with our argument that differences in returns on the firm level comes from the fact that value firms load more in the near future and less in the distant future. Good. So that's basically the story of the paper. What's then missing is why do these near future cash flows have high risk-adjusted returns? And at this point, we are kind of agnostic. So there is this literature, as I mentioned, on the equity term structure that shows that near future cash flows have high risk-adjusted returns, which is kind of a puzzle because it's inconsistent with like long-run risk models and habit models. So following these findings, a lot of different papers have been written suggesting different mechanisms through which near future cash flows could become risky. And we don't have a strong preference for any of these models. We're just arguing that, look, once you have a premium on near future cash flows, the rest of these major risk factors are going to arise from the fact that they invest predominantly in near future cash flows. What we do show, though, is like if you have a model, the Lazarus model actually, which has two things in it, then you're going to get all of these things arising. And the two mechanisms they have is one, they have that discount rate risk is not priced. So long duration firms are going to be very exposed to discount rate risk because they have a long duration, right? But this is not going to be priced. So they're going to be very volatile because they're exposed to changes in discount rates, but this risk is unpriced. So they're going to have a lot of risk that is not priced, which is going to make it look like they have low risk-adjusted returns. On the other hand, they're also going to have in that model that near future cash flows are more exposed to cash flow risk, which is priced, and that's going to make the risk-adjusted return on near future cash flows look risky. So once you have these two mechanisms, we extend the Lazarus model, then we show that actually all these risk factors do arise. But it is a reduced form framework, but you can explain all of them in that model. Good. So we're not the first to talk about duration in the cross-section of stock returns. It all started with Decker, Sloan, and Solomon in 2004, who argued that, well, value stocks kind of look like short duration stocks, and that could potentially explain their return. Back then, I think it didn't really fly, and I don't know why, because I wasn't around back then, but my impression is that people didn't really buy this argument that near future cash flow should have high risk-adjusted returns. But then following the literature on the equity term structure and the finding that actually it does look like near future cash flows have high risk-adjusted returns, this idea has been revived, and we have two other papers that are writing right now that are written in these years. One is showing that actually you can explain the profitability premium with the duration factor, and another paper showing you can also explain the investment premium. What we are doing is we're adding a few more factors to what you can explain, but more interestingly, we're actually linking these factors directly, or we're actually studying the cash flows of the firms in these risk factors and showing that they are in fact investing in short duration firms. And then we have this new dividend futures data that allows us to actually test whether it is a premium and near future cash flow that drives the risk factors. We also have some more stuff in the equity yield curve. We have a model, we have global evidence, but I don't have time to talk about that today. Good. Great. So we're going to have three parts basically of the talk. The first thing is I'm going to show you that these major risk factors invest in short duration firms. And basically what I'm going to show you is that the major risk factors invest in firms with low growth rates. So low growth rate and duration is not going to map one for one, of course, because discount rates also matter for the duration. But basically what we're going to find is that the firms with high expected returns also have low growth rates. Both of those things tend to generate short duration, right? So it's going to be enough just to show you the growth rates, basically. So we're going to show you that we're going to study growth rates in two different ways. We're going to look at realized growth rates, and we're going to look at expected growth rates. The first thing is we take 50 characteristic sort of portfolio, and we calculate then the 15-year growth rates of the firms in the portfolio, just like the figure I showed you on slide 1. We say at formation period, we're looking at the firms that you hold, and then we're looking 15 years into the future for the same firms, what's their growth rates on average. And then we're going to compare these growth rates to the characteristics of the portfolios. We're going to do that for 50 different portfolios, 10 for each of these major characteristics that we're looking at. And then we're running the regression where we're regressing the average growth rates onto the characteristics of the portfolio. This is just time series average, both of them. So we have the realized 15-year dividend growth rate, we regress it on the value characteristic, the profit characteristic, the investment characteristic, low investment characteristic, the low beta characteristic, and the high payout characteristic. So you see these are signs such that a higher characteristic means a higher expected return, a higher risk-adjusted return. And you see all these characteristics that predict high risk-adjusted returns, they also predict or are associated with lower dividend growth rates on average. And these effects are fairly big economically because we have cross-sectional percent measured in percent here. And then we have realized dividend growth rates over 15 years on the other hand. And we do the same thing with the realized 15 years earnings rate, and we find more or less the same result. So it's not only about dividends. Good. So then we also do another exercise, which is a little bit more transparent than what I showed you right here, which is we look at the ex ante expected growth rates from analysts and compare that to the ex ante characteristics. So now we no longer have to compare time series averages with each other. So basically what we do here is we take the long-term growth rates from the IBIS database, which measures the expected growth rate over the next business cycle. Now these are going to be, we know that these are not correct on average, but what we do is we transform them into cross-sectional percent in every month, so it's just the ranking we care about. And then we regress that in a panel regression onto the ex-ante characteristic of the same firm, where the characteristics are also measured in cross-sectional percent. So here we have the regression, we have long-term growth rates on the left-hand side, and we have the characteristics on the right-hand side. And what you see is again that all the long-term growth rates load negatively on all these characteristics here. And again, the economic effect is large, so you see that both are measured in cross-sectional percentiles. So if you change your cross-sectional percentile of value by 1%, you go down by 0.5% the growth rate. So it's a fairly big effect. It's highly significant, and it's really robust to all sorts of sample splits or different things we can do. So this is just like a really robust feature of the data that long-term growth rates are negatively correlated with all of these, related to all of these characteristics. We also have, I don't show you this here, but we also do the univariate correlations that long-term growth rates are also negatively correlated with each of the characteristics. But we think it's very cool that it's negatively correlated to all these characteristics because it helps explain how all of the characteristics can help predict returns if they all help predict growth rates. Now we do this exercise also internationally, so we take the full MSCI World Developed Index and look at and throw out the US, and then we do look at how long-term growth rates relate to ex-ante characteristics, including country fixed effects. And again, we find the same result. Like the economic and statistical significance is slightly lower. We conjecture that's because the data is not as good internationally, but we find the same finding qualitatively, that these long-term growth rates are negatively correlated with all of these characteristics. Then we do these regressions, we also run them in each country. So I'm going to show you, instead of showing you a regression, I'm just going to show you a bar chart where I show you these loadings. So here are the G7 countries. You see in the G7 countries, long-term growth rates load negatively on all of the characteristics, except in Japan where it loads positively on investment. But that's the only outlier we really have in the G7 countries. If we look at all the countries at once, we have a few more outliers, but we still like, by far the majority of these loadings are negative, again suggesting that these characteristics are really negatively related to long-term growth rates. Good, so this is not just a strong empirical association, it's actually also quite intuitive once you start thinking about it. So if you think about a low investment firm, if you don't invest, it's quite intuitive that you're not going to have a very high growth rate, right? And if you think about a high payout firm, if you pay out a lot of your profits, it's probably because you don't see very good growth opportunities, or at least the fact that you pay out the profits mean that you don't invest, so you won't have super high growth. A high profit firm is a little harder to understand, but think about like a low profit firm, a firm that's not making any profit, it's not making any cash flows today, yet it still has a positive value. That's because people expect profits in the future. So a low profit firm must be a long duration firm, and a high profit firm is a short duration firm. Valuation ratio is the easiest to see. Like a value firm is cheap partly because it has low expected growth rates. And then the last thing is the low beta, low volatility, or low risk firms. It's a little bit more complicated also, but generally what's a thing about a high beta firm? That's a firm that moves a lot with the market. When does the market move? Well, the market moves mainly when we have discount rate shocks. So which firms move the most with discount rates? Well, that's the long duration firms, which are very sensitive to discount rate movements, right? So a long duration firm is going to be a high beta firm, high volatility firm, and the other way around, a low beta firm is going to be a short duration firm. Or short duration firm is going to be a low beta, low volatility firm. Good. So that's part one of the paper. I hope I convinced you that actually this is the case, that these risk factors by short duration firms. And if that's really the case, then it also seems natural that we can just combine all these risk factors into one risk factor, namely a duration factor. So that's what we do next. It's going to be more like your usual asset pricing exercise. I'm going to do that a little bit quickly so we can have time to talk about the last section as well. Basically what we do is we create a pharma and fringe type factor based on a duration characteristic. And that duration characteristic comes from the regressions I showed you before of long-term growth rates onto the regressors. Now, we use predicted value rather than the actual long-term growth rates because long-term growth rates are only available for a subset of firms. So we sort of extrapolate the relations between the characteristic and growth rates onto the other firms. And then we construct a duration characteristic based on that. It's just going to be a linear combination of all the other characteristics, okay? Just to be frank about what we're doing. Then we create a duration factor and a size factor based on the usual pharma and fringe 6 factor sort. And then we look at how well this duration factor helps explain the other portfolio. So you know here we have the usual the other factors we talk about: value, profit, investment, low beta, and payout factors. We know they all have high risk or positive CAPM alpha in the usual CAPM regressions. Then when we include our duration factor, the alpha disappears in all the cases, right? So we can actually summarize these 5 major factors just through a duration factor, which we think is a cool result. One note on the size factor here: the size factor is not particularly important in this case because these are size-neutral portfolios on the left-hand side, but if you did not have size-neutral portfolios, it would be necessary to have a size factor in there. That's why we still include it. Good. So what does this duration factor look like? Well, first we can look at the CAPM alpha and expected return to the duration factor. That's what we're plotting here. This is a cumulative alpha and cumulative return over time, and you see that the return is not super high. Forget about the minus here, there should have been a plus. The return is not super high, but it does earn a positive return. And what's interesting is that in the beginning actually it had a negative return. So long duration firms have higher returns than short duration firms, suggesting that the equity term structure was actually upward sloping in the early sample. But the CAPM alpha is positive almost all the way through, and it ends up being fairly large and robust. Like after World War II, it's positive almost throughout the entire sample except through the dot-com bubble. Okay, and this is also robust internationally. We can do this with a global factor. We find more or less the same results. Then we also look at, just to make clear that this duration factor actually captures duration, we look at the growth rates of the long and short duration firms. This is kind of similar to what I showed you in the beginning. What you see is that long duration firm, the cumulative growth rates of their cash flow is just much higher than that for short duration firms, suggesting that actually there is a longer duration in the long duration firms. And we find that approximately the duration of the duration of the firms in the long duration portfolio is around 55 years, and the short duration firms have a duration of around 15 years. So there's a sizable difference in the timing of their cash flows. Good. So then we come to the last part, which probably, which I'm at least excited about, which is we're trying to figure out why this duration factor exists, right? And as I mentioned, we're arguing that this duration factor is a result of a premium and near future cash flow. So just to reiterate our hypothesis, we're arguing that returns on individual cash flows are more or less the same across firms. Value and growth firms have the same return on their 3-year cash flows. But value firms have high return on average because they tend to load more on the near future cash flows, which have high risk-adjusted returns. So we argue that if you look at cash flows to individual firms, they decrease in maturity but are more or less the same across firms. And therefore these weights, which is kind of the weights we use for calculating duration, are going to drive the differences in firm level returns. Good. So this might seem like a difficult hypothesis to test because how do you look at returns to individual cash flows? But as I mentioned, we have this new data of single stock dividend futures, which is pretty ideal for our purposes. So basically this is an exchange traded product which allows you to buy the dividend that's paid out on a given firm in a given year, right? So just to make clear, I pay a price today for receiving the dividends that paid out 3 years from today on Apple, for instance. It's like a zero coupon bond in that I just make a payment today and get one payment again at one point in the future. But of course, we don't know what the dividend is, so it's risky. So there's going to be a risk premium. I'm going to pay less today than what I think the dividend is going to be in the future to compensate me for the risk. These are futures contracts, so all the actual exchange of payments are happening at maturity, right? So there's no sort of compensation for time value of money. It's only about the risk premium on equities. So these are exchange traded on Euro stocks in Europe. We can just go download the prices on Bloomberg. So if any of you are interested, I think there's a lot of interesting stuff you can do with this, both in asset pricing but also in corporate finance. These are all publicly available. We have data from 2010 to 2018. Before that, there was an over-the-counter market, apparently where you could trade it going all the way back to 2003, but I don't have access to that data, so this is just going to be the exchange-traded data. We have 1 to 4 year maturity, and then, of course, this market is not the biggest market in the world. It has a notional outstanding of $6 billion, which is much less than what we look at when we look at the stock market in general. But it's still big enough, I would argue, to be sort of, I mean, there are sizable monies at stake here, right? So it's not, I would argue that this is going to be like investment banks or hedge funds or other smart money that invest fairly large notionals. So the prices are not going to be pure noise. They are going to reflect what they think fundamental value of these dividends are. Good. So this is really cool because this allows us to exactly look at the return on individual cash flows for individual firms. So what we do is we calculate the expected return on these cash flows by saying what's the expected dividend and divide it by the price I have to pay today. So usually we would just look at the in-sample mean to calculate an expected return. We can't really do that in this sample because we only have 8 years of data. So we just do like what's the literal expected return, which is to say we ask the analyst what they think the expected dividend is and divide that by the price. And since we're only looking at big firms because it is only large firms that have these futures traded on them, the dividend expectations are actually not that much off. They're sort of correct on average. And the R square is meaningful, something like 0.8. Of course, it's not 1 because then there wouldn't be any risk. Good, so then we calculate the CAPM alpha, which is just, we take the expected return and we subtract the beta times the market risk premium. And here we calculate the beta, we actually calculate that based on realized returns in samples. So we know we can use a shorter sample for calculating covariances than means, so we are sort of feeling fine about calculating the beta on the realized returns, and then we assume a market risk premium of 5%. So we can subtract that from the expected returns on each claim to get the CAPM alpha. And then just to visualize the results, we're going to have basically short duration firms and long duration firms. So we're going to have 2 different types of firms down here, and we're going to look at what the CAPM alpha is to the different dividends. And of course, we argue that the cash flows decrease in maturity, but they are the same across firms. And that's what we find. We see that the CAPM alpha is higher in the short end and decreases monotonically as we go towards the 4th year claim. And they're more or less the same across firms. If there is any tendency, it is for long duration firms to actually have a slightly higher return, but for all practical purposes, this is the same CAPM alpha. So another way to sort of explain what we're doing here and make you appreciate it is to say, look, we know that short duration firms have high expected returns to long duration firms. So we argue it's because the duration is different on the 2 types of firms, but of course there's a ton of differences between long and short duration firms. Like they have different CEOs, they're in different businesses, they have different growth rates, there's different sentiment, different technology. There's so many things that are different between these firms. So how can we know it's really the duration thing? Well, we can know that in this data because what we can do here is we can say we can fix the firm. So now we fix all the characteristics about the firm, the CEO, the growth rate, the sentiment, everything, and we just vary the maturity of the cash flows. And then we see the effect, right? On the other hand, when we go from top to bottom here, we are fixing the duration of the cash flows, but we are varying everything else about the firm. We're varying the industry they're in, the technology they're using, the CFO, the growth rates, the sentiment, everything. And we look at whether that predicts returns. And that does not predict returns, right? So all these characteristics do not predict returns for fixed maturity claims. That suggests that it is really about the maturity of the cash flows. It is really the maturity of the cash flow that drives these returns. Good, so these are just averages. We also run an actual regression to convince you that this is significant. So we just do a panel regression where we take annualized CAPM alpha on the left-hand side and regress that on some ex-ante characteristics of the firm. And then some maturity dummies that are equal to 1 if the maturity is a 2-year claim. This is equal to 1 if it's a 3-year claim, and it's equal to 1 if it's a 4-year claim. The baseline is then going to be the 1-year claim, of course. And here are the results. You see that the CAPM alpha on the left-hand side, and we have the 2-year, 3-year, 4-year dummy, and they load negatively on all these dummies, and the coefficient is larger the longer the maturity, right? This suggests that CAPM alpha is actually decreasing maturity, and monotonically, and that this effect is statistically significant. We can see that from the standard errors. We also over here include the firm level characteristic, the long-term growth rates. Here we actually use the long-term growth expectations because they are available for all the firms here because we only look at large firms. But we can also use our short duration characteristic. In either case, they load with the wrong sign. So if anything, there's a tendency for these things to predict returns the wrong way, not the way we see in the cross-section of stocks. So that sort of is consistent with our story that the reason that firms with low long-term growth rates or short duration of high returns is that they tend to load on the near future cash flows, not that there is anything about their cash flows that are just fundamentally different. So I'm going to conclude. I don't know if I'm early, but I think I hope I'm more or less on time. What we're showing is that we have duration-driven returns. All the major risk factors, they invest in firms with low growth rates and therefore short cash flow duration, which means we can summarize these into just one factor. So that's sort of like like a dimension reduction, like we talked about this morning with Marcus's talk. And then we're going to show that this one factor, we can actually study the economics of it very precisely through these dividend futures. And what we do is we find evidence consistent with the hypothesis that this factor arises because of a premium on near future cash flows. We also we do not find evidence that let's stay at that these risk factors arise because of a premium on near future cash flows. So in the future, we would like, I haven't shown you this, but we have a reduced form model that explains this, right? The Lazarus model slightly extended. We would like to have a structural model for why this all happens, and we would also like to have some more explicit links to risk of behavioral biases. Right now, we're just saying, look, if near future cash flows are risky or have a high risk-adjusted return, then all these risk factors are going to arise. Okay, thank you very much.